Flexible spending accounts, with illustrated help from Ben. Say hi, Ben. Have you considered using a flexible spending account but chose not to participate because you didn't fully understand it? Or maybe you have participated but wondered if you were taking full advantage of all it had to offer. A flexible spending account, or FSA, is an easy way for you to reduce your taxable income by simply putting money aside in the plan which you would otherwise spend anyway on eligible expenses. Your FSA election is withdrawn from each of your paychecks on a pre-tax basis. That's pre-tax, meaning your taxable income is reduced. You then withdraw money out of the account tax-free for eligible expenses which you incurred during the year. No tax in and no tax out. That's a big deal. The most common types of FSAs are medical FSAs and dependent care FSAs. Let's take a look at medical FSAs first. A medical FSA can be used to pay for out-of-pocket eligible medical expenses you incur throughout the plan year for things like copays, deductibles, prescriptions, and so on. The full list of eligible expenses is maintained by the IRS and can be accessed through the IRS website. Dependent care FSAs can be used to pay for dependent care expenses you incur throughout the plan year for things like daycare, so long as the care is provided by a licensed provider and not a family member. This is most commonly daycare for a younger child, but could also be care for a physically or mentally challenged parent or adult child, so long as they are claimed as a dependent with the IRS. FSAs are best utilized for known and predictable expenses. This includes items such as maintenance medications, vision expenses, routine copays, and daycare. FSAs are not good tools to plan for unexpected expenses. This could include expenses for injuries, emergency surgeries, or diagnostic testing. The reason it's important to plan properly is that you must spend all of the money in the account during the plan year. Any money you do not spend is forfeited. This is often referred to as the use it or lose it provision of FSAs. So long as you plan properly, this provision should not be of great impact to you. Now let's take a look at the funding and reimbursement process of each FSA type, as they do work quite differently. In a medical FSA, your annual election is available to you in full on day one of your plan year. The account is pre-funded with your annual election, and then each of your paychecks has an equal deduction taken to reimburse the account. This means you could potentially withdraw the full amount of your annual election on day one of your plan year and then pay it back into the plan throughout the year. In a dependent care FSA, your account is not pre-funded. Rather, it is funded by the actual deductions taken from each of your paychecks, so you only can take out as much as you've put in. In review, FSAs are great vehicles to use pre-tax dollars to pay for known and predictable expenses you will incur throughout the year. Contact your Human Resources Department for the specifics of the plans offered to you by your employer. There you go, now you know. See ya!